Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching again. We greatly appreciate it. Make sure you hit the subscribe button if you like the content and comment down below. Let me know what you'd like to see next. It's how we decide what stocks to review based on your feedback and comments. And I got a lot of comments on Tesla, so we're going to go through it. But first, I want to remind everybody, this channel is dedicated to fundamental analysis of stocks. We use a value-based approach to estimate the intrinsic value of the stock. We then compare that intrinsic value to the current market price to figure out if there's a financial return or what the economic return looks like if we held that stock over a period of time, typically 5 to 10 years. Now that fundamental analysis is rooted in cash flow. That's why a stock moves. That is why a stock is valued at what it is. It's based on its cash flow, and we use that approach. We use cash flow and we use a market multiple approach to estimate what we believe the intrinsic value of a stock is worth, and we sit back and wait for the market to realize what that intrinsic value truly is. Okay, we're going to take a look at Tesla, and we're going to do this with 5 key attributes that we look for in all investing. 1, top-line revenue growth. 2, earnings growth, as we define it by EBITDA. 3, free cash flow growth. 4 is a strong balance sheet. And 5, it has to be well priced. Again, the intrinsic value is established by cash flow. You compare that with the market price, and that difference is your return over time. If you pay too much for a good company, then the return isn't going to be that stellar. All right, so let's dive into Tesla. This is the 10K. Fiscal year ending December 31st. This is 2019, and we're going to dive into cash flow. So behind me is 10 years of cash flow from the Tesla Corporation, and it's fantastic. It's fantastic predominantly for the growth. In 2011, they had a loss, a negative free cash flow from operations of $128 million. And over the decade, that has grown to a positive $2.4 billion in free cash flow. Now that is excellent free cash flow to operations growth, and it's a hallmark for something we look for. What we also want to do is compare that to its CapEx. Remember, cash flow from operations is not free cash flow, it's a part of the cash flow equation. The next number we need to look at is CapEx. That's your property, plant, and equipment. How much is Tesla putting back into its factories, investing in infrastructure, machinery for its expansion? And Tesla has been expanding aggressively. That's why revenue has gone up so high, and it's represented here by the growth in cash flow from operations. Right? That takes a tremendous amount of investment, and you can see this by comparing these two columns. You'll notice cash flow from operations plus the negative CapEx, the outflow of money. This is predominantly negative every year for the decade. That is them investing in the future, which is fine, totally understandable, and we'd like to see that for a growth stock. And this is pretty much negative all the way to the most recent year. How are they funding this investment? They fund it one of 2 ways. One, through debt, and the other through shareholder equity. And what they're doing is they're investing in new plants, the gigafactories around the world, and then they're borrowing money from the bank, and they're issuing stock as the equity piece. So you can see that for the debt payments here, they're all positive. That means all the debt payment is basically money coming in. Shares outstanding started at 100 million, went to 177 million. That is share that they're issuing to get cash from equity. They go to the bank or they borrow cash, they combine the money, and they go build a new factory. And over time, when that factory is built and up and running, it produces cash flow. That's what we're saying. And we're okay with that because we know the stock is marching forward, it's going north, and we're fine with them investing in that activity because it seems profitable to do so. Right? All this CapEx is now turning into positive free cash flow, which is good. Finishing the cash flow equation here, you can see cash flow to equity per share. It's this number divided by the shares to give me per share value. This is what intrinsic value is based on, and you'll see here it's all over the map, which is understandable. Tesla is growing, they're reinvesting, cash flow is going to be spotty. But the large swings, positive, negative, positive, it's very difficult for us to use this to go forward. What are we supposed to do? Take the $7.11 and just string it forward at an average growth rate? That doesn't smell right. it's 2 all over. I don't know if this $7.11 is proper to pick up as a basis for a growth formula. Even averaging it gives you really odd results. You'll see here that the yield, this free cash flow divided by the average stock price, is negative 0.4, and they do have a strong growth rate of 38%, but again, the 38% is based on numbers that swing wildly high and wildly low. So what we're going to do is we're going to say that we can't use free cash flow as the basis for intrinsic value because it's all over the map, and it's too risky to take this one data point and peg the entire company's valuation on that one number. So we're going to put this on hold, and we're going to go to our next approach. The next approach we're going to use is a market multiple approach based on EBITDA. All right, here we are with the market multiple approach. This is 10 years of revenue of Tesla. And you can see revenue is growing much like it was for the cash flow from operations. It starts at $200 million of revenue and has grown to $24.5 billion of revenue. Excellent. And it's one of those check boxes that we want to see here at this channel, strong revenue growth. They certainly have it. Growing, I think that's 6x. Might be more than that actually. It's 100% annually over the decade, which is amazing growth. The next thing we need to do is we need to look at earnings. And in this channel, we look at EBITDA as earnings because we're trying to value the entire company as a whole. And if you go all the way down the P&L to EPS, EPS can be distracted. EPS is essentially net income divided by diluted shares outstanding or common shares outstanding. And that can be impacted by write-downs, it can be impacted by currency fluctuations, it can be impacted by the shutdown of operations, all kinds of non-operational charges can move EPS, and it can be adjusted by management here or there a little bit. So we pick up EBITDA as a total enterprise earnings metric. And what we're going to do is we're going to start with earnings before tax, interest and tax, EBIT, or also called operating income. You can find it on their 10K P&L. So they started as a loss of 250 and they've grown it, well actually with all their reinvestments it's really not moving. We'll add back depreciation for a non-cash cost to get EBITDA. And what you'll find is EBITDA, our metric of earnings, is growing. And it's $2.2 billion, which is very similar to the 2.2 that we saw for, or 2.4 for cash flow from operations. So that's good. They're fairly consistent. The average growth is 13%. Let's move on down and get the enterprise value. So the enterprise value is the sum of, remember, debt, market cap, less excess cash. Here's their debt. This is debt from the balance sheet. And you saw in the last cash flow that they're issuing debt to bring money in. This is represented by growing debt on the balance sheet, $16 billion, the latest filing. Market cap, shares outstanding by price. Recently, Tesla has had an amazing move in the price of the stock, so this market cap is currently much higher than where it is right now in this sheet. Enterprise value is the sum of these two, and I'm going to get a market multiple by taking enterprise value and dividing it by the EBITDA. Basically, how many years it would take the EBITDA to pay back the investment of buying the company. And you can see this also swings wildly, much like we've seen with the cash flow metric, from a negative number based on negative EBITDA, which makes sense, to a monstrous number here based on low EBITDA but some traction, and investors are giving them credit for that. So here, this is coming down to earth. And most recent enterprise value EBITDA is 36 times, which is still a rich multiple, and it's reflecting the growth that investors expect them to achieve. All right, average EV is 95, EV to EBITDA, and their debt ratio, average debt ratio is 14 times. Again, same thing here. Super high number based on low EBITDAs, and then it's come down to earth as EBITDA has materialized. I would expect this number to be in the 4x range. If you look at other automotive companies, they are very capital intensive, and rather than issuing equity, they will issue debt and carry a larger debt balance. So I think going forward, this number comes down, but it's not going to come down below the 3 number, which is what we normally like to see. This is going to stay north of 3. I'm going to guess it at 4. Okay. We couldn't use cash flow. Here's an EBITDA. What do? how do you establish the intrinsic value of Tesla? Do you just take the 2.27 billion of EBITDA, grow it at 13%? No. Why? Because it's too all over the map. Just like we said with cash flow, its growth is positive, negative, triple digits. It's crazy. We can't take this as a reasonable assumption and just string it forward linearly, even exponentially. It just doesn't pass the smell test. So what we're going to do is we're going to look at a market landscape, and we're going to say that Tesla over the next 10 years is going to grow and become a major automotive company, right? So I get it. Before you send me emails, Tesla has a lot of other features outside of just automobile sales, right? They've got their battery business, they've got the solar power business. So I do expect them to get a lot of revenue from that, but predominantly their sales will be automobiles, and predominantly they're investing in automobiles. So we're going to start there, and we can make some changes to gear for that extra revenue. But as the lion's share of their business is automobile sales, we're going to stick with that. So here's some competition. I've picked 5 large automobile companies around the world, looked at their revenue, looked at their EBITDA, looked at EBITDA margin, and looked at enterprise value EBITDA to give us a basis on what we think we can use to establish an intrinsic value of Tesla. What you'll see is Ford, GM, Fiat, BMW, and Toyota revenues range from a low of 100 to a high of $270 billion. Margins. EBITDA margins range on the low end of 9 to the high end of 15. EBITDA multiple, EV to enterprise value, high of 12, low of 2.2. That 2.2 is crazy low. For Fiat, I got to take a look at that. I've smell checked it quickly. It does seem like the math is right, but there's got to be some reason why it's that low. 2 times the enterprise value for a company doing 120 billion in revenue is crazy low. We'll take a look at that. But for right now, this is just giving us a picture. There are others, BYD, Ferrari, there's others that are higher end that have a higher multiple. So what we're going to do, we're going to peg a revenue number. And we're going to say the average here is $159 billion, and we're going to use that. Now I've seen other revenue estimates for Tesla that are in the $150 billion range. So taking the average here seems okay to me. And we're going to say that that average is going to happen in 10 years from now. Could it happen sooner? Absolutely. I mean, they've been growing well, but going from 24 billion to 159 billion is still a 6x move on revenue, which is a massive move. And I think that it's going to take them a long time. Is it 5 years? I don't know. Is it 10 years? Maybe. But we can bake that into our analysis when we're coming up with the intrinsic value. So what we're going to do is we're going to average these, and we need to pick a margin to give an EBITDA. So average here is 159 billion. I'm going to take the high margin of 15%. I'll say in 10 years, they're going to have 159 billion of revenue and 15% EBITDA margin. I'm giving the high, that's the average. I'm giving the high number because I think that they have other sales, right? They've got the batteries, they've got solar systems, and because their cars don't have the internal combustion engine, there's probably software upgrade revenue that they get. There's lots of other stuff. I think that the margin's going to creep north. So I'm going to give them a 15% margin. Now, EBITDA, enterprise value, I think these are all too low for Tesla. In looking at this, you can peg the high one at 12, but even 12x EBITDA for the kind of industry dynamic here. I think these guys are being priced lower because the industry is waiting for Tesla to catch up. So Tesla's going to have a higher multiple than these guys. I'm going to give it a 15 times multiple. So what does that do to our valuation? All right, so here we are. We're going to look at the enterprise value of Tesla. We've got our revenue forecast of $160 billion. We're going to apply that 15% EBITDA margin to that $160 billion of revenue to give me $23.9 billion of EBITDA in 2029. Okay, now that we have an EBITDA estimate, we can get an enterprise value. And we can get an enterprise value by applying the market multiple of 15 times to this number to get $360 billion of enterprise value 10 years from now. And again, I think this follows the trend of decreasing EBITDA multiples, And as the business gets bigger and bigger, it's not going to have this growth multiple, it's going to have a more market-based multiple, which is your 15 times. So now, what do we do with enterprise value? Well, we can estimate the debt. I'm saying that they're going to have 4 times EBITDA of debt based on being a capital-intensive business. They're not going to use all equity to fund it, so they'll have debt. And then that debt minus the enterprise value gives me an estimated market cap of $262 billion 10 years from now. Okay, now we've got the market cap that we believe they're going to have. We need to estimate the share price that you're going to have. So you need fully diluted shares. So let's go back up for a second and highlight this section. Right, this section showed that they're continuing to issue shares, and I think this is going to happen in the future. Also, if you read the 10K carefully, there's some debt that's convertible into equity. Long and the short of it is, I think over the decade, these shares will continue to grow to around 208 million shares. How'd I get there? The conversion of debt is a roughly 11 million extra shares, and then I'm applying a small growth rate to these shares for certainly Elon Musk's bonus comp will be dilutive, company employees' share issuance plan, and the fact that they're probably not going to be buying back stock anytime recently. They're going to take that proceeds to fund the growth. So I'm pegging future shares at 208 million shares. And now let's go look at the market cap and the share price. Let's find the share price for Tesla. We know we have an estimated enterprise value of $358 billion. We know that we think they're going to have $95 billion of debt. That's 4 times EBITDA. Subtract the two, I get a market cap. Market cap, we know we have share price, we think we have shares outstanding of 200 million. That gives me a $1,259 stock price valuation in 10 years. And again, to recap, this is a $160 billion of revenue at a 15% EBITDA margin at 15 times EBITDA to enterprise value gives me an enterprise value of $358 billion. Subtract the debt, market cap, less total shares outstanding and fully diluted, gives me $1,259 a share. Okay, now we have what we believe the intrinsic value of Tesla is. It's $1,259. Now what do? Now let's look at the current share price and we'll come up with what we think the economic return would be if you bought it today. So here we go. We've already said that we're not going to be using the free cash flow method because there's no free cash flow to be, it's not predictable enough, and they most likely won't dividend any money out. They're going to use that cash to reinvest. So we've chosen the market multiple. We're going to rely 100% on that, and that value is $1,259. Current share price is $735. Excuse me, $753. Excuse me. So what does that look like an economic return? Let's go to our trusted IRR calculation. All right. So here you go. You buy the stock for $753 today. You get 0 for a decade, and that decade you exit at $1,259. It's a 6% IRR, or 1.7 times cash on cash. Now, one thing that could happen, actually there's several things that can happen. One, this share price can change, and that'll affect the IRR. For example, if this share price came down and you bought it at a lower number, your IRR would go up because this hasn't changed. The intrinsic value is what it is. Or Tesla could grow faster. Maybe it doesn't take them a decade to get to $159 billion of revenue. Let's say they did it in 5 years. So this could come up here, and that would boost your return as well. So what we can do is we can look at a couple different scenarios. Let's say that they make this this level earlier. So if they did that, excuse me, there we go. So if they achieved their 2029 target of $159 billion by 2025, so it's 5 years from now, your IRR would be 11%. Now that doesn't smell check to me though. Growing revenue 6-fold in 5 years is monstrous. And even Tesla, I think, is going to be able to, I think that's even a stretch for them. So I'm going to leave this back down at the decade level, give them 10 years to hit it, because who knows, all kinds of random things happen. So you want to give them the time to achieve it. So what we're going to do is this is not stellar. This is not the return that we want for a stock that has done largely well historically. And I think the recent run-up in price that we've had, maybe investors are getting a little ahead of themselves, and I would expect this to pull back a little bit, and if it pulled back, it might make a very nice entry point into the stock, whose value should be roughly $1,300 a share, all right, $1,259. So let's move these two numbers. We're going to create a distribution for you and show you where you should buy the stock to get a better return. And I'm going to be doing these going forward. And what I would like to do is show you what price you can buy a stock at to get a particular return. So we've already established that we think the enterprise value of, or the share price value, the intrinsic value of Tesla is $1,259. The stock price is over here, and the stock price is moving up, down, all around. But if we wait and there's a pullback for whatever reason, and we don't believe that fundamentally the economics have changed in Tesla, then the stock has just become more attractive to us and a better deal. So the question is, at what price do you need to buy Tesla to get a return that's acceptable to you? That's what this is saying. So this is the stock price that you would buy the stock today, holding the $1,259 future value constant. I can show you the economic return you're going to get based on what you buy the stock at. We're here, $700 roughly, with a 7% IRR approximately. If the stock were to pull back down to where it has been in recent history, right, back to the $400 range, that looks like a very much more attractive entrance point for us. And over the long term, you get 14% IRR, even higher if they brought that 10-year into the 2025 range. So I think what this is saying is that the risk-return trade-off, right, the probability that Tesla hits their revenue forecast, hits the EBITDA multiple and the margins, there's a lot of ifs in that statement. And I think the risk that the stock goes down right now recently is higher than the risk of it going up. So I would expect to hang out and wait, let the stock come back down to earth. It might take a while. And then when it does, pick it up, because long term it is a great investment. And I think that the long-term shareholder value is there. The market just got ahead of itself with its recent run-up. All right, so I'm going to do this in future for other investments. But let's now go down to see this next chart is basically saying, I will leave the stock price at $753 today. Okay, if you believe that the revenue of Tesla is going to be higher than $159 billion, what does revenue need to be at a 15% EBITDA margin, a 15 times market multiple, to make the IRR work for us? Right. So this is another way to smell check the data, another sensitivity table. So we're here, kind of in between these two. 160 billion is our estimate. In order to get the upper teens IRR, you need to be $300 to $500 million of revenue to achieve that. That's pretty strong. If you remember the market landscape that we had over there, the 5 companies, right? You add all those up, and you're going to be in this range here of total market landscape revenue. I think asking or assuming that Tesla takes all of that is a huge assumption. It's easier to assume it falls in maybe even sub 300 range over a decade, but not north of $600 billion. But this is another way to look at the value of a company based on revenue targeting. All right, so this is a little distribution curve. I like Tesla. I think it's got a lot of the attributes that we look for, right? Strong revenue growth, EBITDA growth. Free cash flows has turned positive, but they're investing so much, there's not much to distribute. That's kind of half credit. Balance sheet, it has more debt on it than we would like, and well priced, which is not. It's too expensive right now, and the upside has already been priced in the stock. So for this reason, we're going to give it a meh, right? Because there's a lot that we like, but we don't think the stock is priced appropriately to buy in right now. And I'd rather sit on the sideline, see what happens, and it's something is going to happen in the market that's going to cause the price to go down, and that would be a much more attractive entrance point. All right. Tesla's intrinsic value and economic analysis, check. what this is and what I'm going to do going forward is I'll start producing for you pricing distributions like this for each stock that I review. And what I'd like you to do is over time, as the years go forward, or as this year goes forward, the stock prices are going to move up and down. You can check back into this channel and see what did I assign the IRR to at different pricing. As the stock price moves here and up and down, if the economics of the business hasn't changed, then intrinsic value is still there, right? Value is what you get, price is what you pay. So you want to find a good value, which Tesla's good value, almost $1,300. You wait for the price to come down so the economics work for you. If it's in the $400 or $500 range, that's a great return over a decade. I would say buy it at that point. But I'll do this for each stock going forward. As the stock price moves, as the economy kind of gets back in line, check back into your favorite videos, see what the distribution curve looks like to figure out if you should buy it or not and what economics you can expect. All right, my name is Cameron Stewart. Thank you very much for watching Rational Investing. This has been a review of Tesla. Please comment, let me know what you think, and subscribe if you like the content. We're going to be doing a lot more stock here in the next couple months, and I really look forward to your feedback. Thank you very much. Have a great day. Bye-bye.